class action suits so much as yet. But over a period of time when people get a little wiser, that may be one issue which we all will have to face. And of course there will be impact on the credit rating and investor perception. Basically there are four mandatory, like Companies Act is there, IC accounting standards or Ind AS is there, SEBI is there, and income tax, GST and other fiscal laws may be there. So these are the laws, regulatory framework which we have to comply with. As a chartered accountant, what is your role? You should ensure that financial reporting and disclosures are accurate, implement checks and internal controls, stay updated with applicable standards and laws, guide management on best practices, and lastly, provide an independent opinion on the compliance. Benefits of strong compliance culture is prevents reputational and financial damage, enhances internal accountability and governance, improves chances of attracting funding and partnerships, reduces the risk of fraud and manipulation, and facilitates smooth statutory audits and peer reviews. Now what I have done is, I have taken about 90 cases, because there are many cases, and she would have published, they have got regularly, no, but I am going to now take, 90 cases I am going to go through. But these are all illustrative. It is not that these are the only non-compliances that are there. But I have tried that they are very common, really, which is applicable to most of us. I have avoided Ind AS not much, because most of us are doing non-Ind AS. So therefore I have avoided that. But generally I have taken about 90 cases. So let's start with each case now. The first case, income from leasing was shown as income from operations. The corporate governance report stated that the company was mainly engaged in setting up or operating industrial infrastructure. The company was also engaged in related activities involving leasing and providing services connected with the computer software and data processing. Now you just see the error over here. Of course, one of the objects is leasing, but that is not the main object. The main object of the company was to set up and operate industrial infrastructure. So basically now see the non-compliance. As stated in the report on corporate governance, leasing is a secondary business for the company for which the accounting policy has been disclosed. That is fine. However, no accounting policy has been explicitly disclosed for recognizing revenue as adopted by it from its primary business, namely setting up and operating industrial infrastructure. The accounting policy adopted by the company for recognizing revenue from its primary business, together with the timing for recognition, also should be disclosed. So even if there is no business, but still the policy should be disclosed. So that is very, very important. The second case, intangible assets are recognized and accounted at cost in accordance with the accounting standard 26, intangible assets issued by ICAR. In case of subsidies, the policy stated that the subsidies are recognized in accordance with the relevant terms and conditions of the scheme and arrangement. And whereas for gratuity, the policy stated that the gratuity is provided as per the approval of the central government and as per the Payment of Gratuity Act. Now here, the disclosures are there, but really there is no disclosure. Now see what the non-compliance is. That it was viewed that such policies only provide means to understand these accounting policies. That means, as per the accounting standard 26, as per the terms of the and subsidies and the gratuity as per the act. So the user has to go to those places. That is not what is expected. It is expected that the policy, what you are doing in that particular that should be disclosed. That is very, very important. Third, it was stated that MAT credit entitlement of significant amount has been recognized in the financial statements with corresponding recognition of the related asset as shown in the long-term loans and advances. Now, what is the non-compliance? MAT credit should be recognized as an asset only when and to the extent there is convincing evidence that the company will pay normal income tax during the specified period. Though MAT credit entitlement was significant amount, the accounting policy adopted for its recognition was not disclosed. So, just merely just disclosing the amount is not enough. The policy also has to be specified. And basically, I will tell you, in the non-compliance and compliance, as you go through further, it is not necessary. Sometimes you may give the policy, but you may not show it in the financial statement. So, if there is a contradiction, definitely it will be a non-compliance. That must be remembered.
It is reasonable certainty or virtual certainty
Sorry?
for this MAT credit entitlement recognition?
No, sorry again.
It is virtual certainty or reasonable certainty we should have for recognizing the MAT credit? Reasonable
Virtual?
certainty will do, or we should have the proof of the projections and all that?
No.
Or management should ensure?
MAT credit would depend basically
On
on
normal
your
income tax.
actual whatever is on that. So, I have not followed your virtual. How?
Is there any evidence to show that they will be entitled for normal tax law?
Yeah, definitely. You must have the working with you. You may not give the working. Policy will be disclosed, but working may not be there. But whatever extent disclosure is required, only that means.
Just for carry forward losses and depreciation, we need virtual certainty. So in this case, whether we need virtual certainty or reasonable certainty?
I don't know. Let me just apply my mind and give you but I think it is. Yeah, I'll go a little further. Tangible fixed assets are stated at cost or revalued amount as the case may be, less accumulated depreciation, the impairment loss, if any. Cost comprises the purchase price, borrowing costs, if capitalization criteria are met, and any attributable cost of bringing the asset to its present working condition for its intended use. No separate policy was stated for the treatment of the borrowing costs. Now here you will see that it is mentioned that it is cost comprises the purchase price if capitalization criteria is met. But what is this capitalization criteria? That is not stated. So the user should not be left high-handed, that okay, a particular criteria is mentioned, but it is not, the actual criteria is not given. That should not happen. The criteria used for capitalization have not been disclosed in the policy, and therefore it is not in compliance with accounting standard 16. Next case. The company has no manufacturing activity since 1992-93, and hence additional information regarding license capacity, installed capacity, actual production and quantitative details of production, sales and closing stock in respect to the previous year is not given. Further, the revenue from operation has been shown in the statement of profit and loss account. Now you see, revenue from operations is there, but its main operations they are not doing since 92-93. So therefore, there is again contradiction. Although the statement of profit and loss shows revenue from operations, the accounting policy as adopted for recognizing such revenue was not given. The nature of operation for which revenue has been generated is not clear from the financial statements. So despite the company has no manufacturing activity, revenue from operation has still been disclosed. So it should be actually other income, not operating income, or other operating income, if that is also one of the objects. In the annual report, certain accounting policies, investments, namely investments, other income, foreign currency, etc., were disclosed in one note titled Significant Accounting Policies. Whereas other accounting policies, namely relating to deferred tax, inventory valuation, employee benefits, hedging contracts, employee stock option scheme, etc., they have been given under the related notes annexed to the balance sheet and profit and loss. Now see, all the state policies are stated, but they are not at one place. And because it is not at one place, it is a non-compliance. So, as I told you, improper presentation. This is one case of improper presentation. I mean, this is a further same thing, that is, and the law has been given that paragraph 25 of Accounting Standard 1 specifies that significant accounting policies as such should form part of the financial statement, and the significant accounting should be normally disclosed at one place. So that is the requirement of the standard. Okay. The revenue from operation comprised of income from real estate projects and other operating income. However, they have given additional information that this other operating constituted 95% of the total income. Now, if that is the case, you have to give the details what that other income is, what are the accounting policies thereof, all has to be given. So many a times it may, you have to see whatever accounting policies you have disclosed and whatever accounts you are doing, whether they are in tandem or not. And that, if they are not, then there would be a non-compliance. In an annual report of a banking enterprise, the particulars of securities purchased and sold under repo, reverse repo were disclosed only by way of a note to the financial statements. So, the non-compliance, all these non-compliances examples I have taken from the institute publication. It's not something that I have invented or I have, basically it's the institutes which they have found from, going through all the various annual reports. So for a banking enterprise, accounting policy relating to repo or reverse repo is important since it is a monetary measure of RBI to control inflation. So it was therefore necessary that recognition as well as measurement principles in respect of securities sold and purchased under repo and reverse repo should have been disclosed. That was not disclosed. Only merely a note is not sufficient. In an annual report with regard to accounting of income and expense, the following disclosures were made. All income and expenditure having a material bearing on the financial statements are recognized on accrual basis. Expenses and income are accounted for on an accrual basis. Income and expense are recognized on, and these are various companies, how they have given the disclosures. So on accrual basis, except benefits on special import license premium, sales tax set-off, duty drawback, and all other incentives, claims receivable, which have been accounted on cash basis. So there are certain things on cash basis, the rest are on, you have disclosed it. But you will have to qualify the report because you are not complying with the standard. Now what is the standard requirement? Only a common policy of recognizing income and expenditure was given, and that the accounting people were recognizing revenue, including the point of time when the significant risk and rewards in goods stand transferred, was not stated. So exactly when that thing is there, revenue recognition policy should be separately disclosed, stating explicitly the timing of recognition of revenue. When in subsequent examples I'll show you what is the, like many a times, in an event, tickets are sold. Now tickets are sold at income when it is to be recognized, whether at the time of sale of tickets or when the event takes place. So these are very, very important things. That's why okay, for the accounting of import license benefits, duty drawback, claims, cash incentive, etc. is not in accordance with the general accepted accounting policies, because you are supposed to be done on accrual basis. Some of them is on cash basis. There is not a proper, therefore you will have to give a qualification to that extent. In an annual report, there were various items, but no accounting policy was stated or was disclosed to one or more of the following: that's fixed assets, inventories, provisions and contingent liabilities, impairment of assets, accounting of taxes and income, revenue recognition, and so on and so forth. So all these things, items were there in the financial statements, but the accounting policies was not mentioned. That is a non-compliance. Companies would generally have most of the assets and liabilities and income and expenses, and therefore, even interest in commission and royalty included under other income could be significant. Accordingly, subject to circular, all significant accounting policies should be disclosed as adopted by it for preparation and presentation. Next, the accounting policy regarding employee benefits as given in liabilities for gratuity and leave encashment are provided on the basis of annual actuarial valuation of the year at the year end, and the management estimates for interim period keeping in view of last actuarial valuation. Of course, this I have taken only the specific disclosure. However, it was observed from the notes to account that the company had also made contribution to provident fund, but accounting policy for contribution of provident fund was not stated. So you see, the financial statements shows provident fund, but there is no accounting policy. So that should not happen, and you have to, accounting policy covering all types of employee benefits should be disclosed. In an annual report of a company, it was stated that the company had been set up for plantation. Further, the seeds of the plants were used for production of biodiesel as variable renewable source of energy. It was further noted from the accounting policies as disclosed in the financial statements that all expenses incurred on cultivation and maintenance of plantation were transferred to capital work in progress for a period of 5 years, and thereafter these expenses were capitalized to be amortized over a period of 25 years. Okay. Now this is this was there, but now what is that? That the stated account indicated that plantation was a self-constructed item of the property, plant and equipment. Since all expenses were transferred to capital work in progress, it appears to be still in development stage. Accordingly, any income generated from pre-harvest produce of bearer plant is in the nature of income generated before the commencement of the commercial operation and should have been deducted from the development cost. However, the company, what it had done, it had shown the income earned from immature crop and credited to the profit and loss account, which is not a correct answer, because the things are not ready. So anything prior to the commercial operation has to be capitalized and cannot be shown as income. What I have done also, another thing I will tell you, that I have utilized, tried to take from every accounting standard at least one example or two examples as the case may be, so that we cover up maximum. That is what I have done. Except of the disclosure of inventories. Inventories are measured at cost. Cost is determined on weighted average basis. Work in progress. These are various annual reports, not just one. Work in progress is valued at direct raw material cost and appropriate cost of completed process. Raw materials are valued at average cost. Raw materials are at bonded warehouse stores, etc. are valued at cost, and finished goods are valued at cost or net realizable value, whichever is lower. Raw material stock, stores and spares stock in process are valued at weighted average cost. And lastly, raw materials, packing materials are valued at cost on FIFO basis. Now the requirement is inventory should be valued at lower of cost or net realizable value. So that is the requirement of the accounting standard. The net realizable value is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. So from there it was noted that the accounting policy has disclosed the fact except for finished goods in the few cases, inventories had been valued at cost or average cost. In other words, net realizable value was not considered at all. So that is I have taken little more examples of inventories. So inventories are valued at lower of cost or net realizable value, or raw materials, process stock, stores valued at cost. Finished goods are valued at cost or market price, whichever is lower. Semi-finished goods are valued at estimated cost. I underline the word estimated cost. Then items of inventories are measured at lower of cost or net realizable value after providing for obsolescence. Now here you have to, it was noted that the accounting policy of this company, that although the accounting policy adopted for determining the value of inventory had been disclosed, the cost formula adopted for determining the cost was not disclosed. So whether it was weighted average, whether it was simple, that is not stated at all. So that is basically the non-compliance. And also the FIFO or what method you are following regarding the accounting has to be also stated. In an annual report, following note was that the liability for excise duty on finished goods lying in stock at the close of the year has not been provided for in the accounts, and hence not included in the valuation of inventory of such products. However, the said liability, if accounted, would have no impact on the profit of the year, profit for the year. Raw material and finished goods are valued net of excise duty, but goods at branches are valued at inclusive of excise duty and freight. Liability for excise duty on finished goods is accounted as and when they are cleared from the factory premises. No provision is made in the account for goods manufactured and lying in the factory premises. Now here, the flaw is that normally at that time excise duty, it was applicable on production, on the manufacture. So the moment the goods are manufactured, it has to be provided in the books of accounts. But it was not done. So whatever the accounting policy followed by the company was not in tandem with the accounting standard. In an annual report, it was stated stock of paper, books and magazines is as certified by the manager. This is also another a term which is used by many annual reports. Raw materials, consumable stores and spares are valued at lower of cost as certified by the manager. Finished goods are valued at lower of cost or net realizable as certified by the manager. Now, what is the flaw? I think you will know that the words as certified by the management is not accepted. Yeah. So here it must be noted that the auditor should conduct certain audit procedure to satisfy himself that whatever value is stated is correct. Merely acceptance of what is certified by the management is not correct. Then he is just a postman, which is not accepted. Of course, they have mentioned like that, the auditors should advise their clients to open the inspection as taken, valued and certified by the director of finance. But advisor, you have to ensure that you do the things and at least from your side, you clear up that. Work in process at raw material cost, cost of finished goods and work in are determined at estimated cost basis. Inventories are valued at cost or net realizable value, whichever is less. However, cost is determined by using the first in, first out formula. Cost comprises all. Raw materials are valued at average cost. This is the disclosure. Now, what is in the first case, the work in progress has been valued at raw material cost, and whatever the cost of conversion, that has not been considered. For a work in process, it is not just raw material, but even there is some other expenses which are there. They were not included. In the second case, finished goods and work in process is determined on estimated basis. Again, that is not acceptable. Because if you do it on estimated basis, your profit, you can do what you want and manipulate. In the third case, it states that cost comprises all, but it is not clear from such accounting policy whether all applicable costs have been considered or not. So, how do I determine that? In the fourth case, average cost method has been used instead of weighted average. So, these are the non-compliances that you have to do. So, many a times, the disclosure is there, but it's as good as non-disclosure. The accounting policy on valuation of inventories was not disclosed. Again, this is a major flaw because one has to give the disclosure of how the valuation is done. Short-term provisions, including provisions towards old inventory and amount, is significant. That is what is mentioned. Now here it was observed that the provision for old inventory has been shown under the head short-term provisions instead of reducing it from the carrying value of inventory. So what you ideally do is that you reduce it from the value and show in the net figure. Here they are shown separately as short provision. That is not correct. And it raises a doubt as to whether net realizable value has been considered for valuation of old inventories or not. That is not clear. Import of materials is accounted on receipt thereof at the factory. Now, here the major flaw is that the moment the risk is transferred to us on import, the goods should be shown in our books. If the goods are not there in the stock, they may be in transit, then they have to be accordingly shown as materials in transit. So basically that is very important. Inventory, stores and spares have been disclosed on net basis. Now here again, net basis, net of what? Which are gross, what is net, what has been reduced, nothing is mentioned. So there is no compliance according to it. In an accounting annual report, the accounting policy on inventory stated that the cost of raw materials, components, stores and spares is determined on a weighted average. However, a note in the note of inventories under the head raw materials, it has been stated that it is valued at cost on FIFO method. So now you see here in the policies you have mentioned it is weighted average cost method. In the notes to accounts you have mentioned it is FIFO method. So again this is a contradiction. When there is a contradiction, there is no compliance. Again, I am so sorry. The accounting policy inventory stated that the raw materials, stock in process, finished goods and stores and spares have been valued at cost, and that scrap value has been valued at net realizable value. In the note, it has been stated that scrap has been valued at estimated market price. So again, there is a contradiction. Okay, so that should not be the. From the statement of profit and loss and the cash flow statement read with, it was noted that net profit for the year is inclusive of unrealized exchange rate difference interest and dividend income. Now, these are the requirements of this. Let us go to the what is the non-compliance. The figure of net profit which has been used to determine the cash flow has been derived after adjusting the exchange rate difference. Now, this exchange rate difference is not a operating activity, it is a financing activity. So that there will be a change over there. It was further noted that for determining the cash flow from operating activity, basis used is net profit, including the interest income and dividend income. These are actually, therefore showing it. It should be shown under investing activities because dividend and all that, and not under operating activities. So that is what is the non-compliance. Cash flow statement of a financial company was noted that the following items were disclosed in cash flow from financing activities: loan repayments and loan disbursements. What is the flaw is that this is a financial company. So loan payment, loan disbursement, all this is operating activity. So this is not a financing activity, it is a operating activity. So, and every statement that you make in the annual report is important. So just don't go on cut and paste. Really, you have to read them, apply, see whether it is really applied in the financial statement, and accordingly take a call. Okay. Though the company was a subsidiary of a listed company, however, cash flow statement was not prepared as part of its financial statements on the ground that it was a small, medium-sized enterprise having regard to its turnover. So even at that point of time, if it was a subsidiary of a listed company, you are supposed to, it was not exempted. So that was a flaw actually. You should have disclosed the cash flow statement for that particular cash flow statement given in the annual report of a non-financial company. Now, it was noted that interest paid has been shown under cash flow from operating activities, whereas interest received has been shown under cash flow from financing activities. In another report, dividend paid has been shown as cash flow arising from investing activities, and dividend received has been shown as cash flow from financing activity. Now what are the since it's a non-financial company, interest paid is in the nature of cost flow from financing activity. So basically it's not operating under definite income. Similarly, interest received is in the nature of cash flow from investing activity. Even the dividend inflow is cash flow arising from income from investing activities, whereas dividend paid is cash flow arising from financing activities. So this, what type, is also very important. So under cash flow also you have to ensure. Cash flow statement of financial company has been noted that changes in borrowings were disclosed under cash flow from financial activities. So basically here, the cash flow on account of borrowing in case of all enterprises, whether financial or not, it is from financial activity. And it does not make a distinction between financial and non-financial. So it has to be on the same basis. In an annual report, the checks received from XYZ Marketing Services Private Limited were dishonored during the year. The company has initiated legal proceedings against the said party under section 138 of the Negotiation Act. The management is confident of recovery of the dues and hence no provision is required. So no provision was made. Now the non-compliance is that suit was filed. However confident you may be, there would be a contingent liability, and that contingent liability has to be disclosed, which was not done by the company. And so there is a non-compliance. So many a times you may make a innocent statement, but if it is not backed by other information, it may prove to be a non-compliance. Okay. It has been noted that income may have been directly credited or debited to reserves and surplus. Gain on commutation of sales tax deferral loan, short provision for bonus, provision for income tax relating to earlier years, and investment written off. Now, directly doing it in reserves and surplus is not permitted. You have to go to the profit and loss account. Basically, that is the requirement, and accordingly you have to. From the annual report of a company, it has been noted that certain extraordinary items. I tried to take extraordinary items and exceptional items because many a times people get So extraordinary have been disclosed in the under cash flow from operating activities. However, no extraordinary items have been disclosed in the statement of profit and loss. So you have mentioned it, in the cash flow, but not in the, which is again not correct. So they should be in tandem, both the. So it was observed that whereas certain extraordinary have been disclosed in cash flow statement, no such disclosure was made. That is not correct. Okay. Now this prior period items, prior period income was shown as other income under prior period expenses shown under selling and distribution, prior period expenses shown in the profit and loss account. So all these are prior period, but their disclosure or nature of an amount of prior period item should be separately disclosed. So if you have just given prior period item, that is not so. So in the note at least you should give the details of what are those prior period items. In an annual report, sundry balances written off has been disclosed as prior period adjustment. Now here you have written off the sundry balances in this year, though it relates to the debtors of the earlier years, but the decision was made this year, so it cannot be a prior period item. So it has to be a current item. So whatever you have written off. It has been noted the following items have been disclosed as exception items. Gain on finance lease arrangement, the right back of compensation on the employee stock option scheme, loss on fair value of derivative contract, foreign currency translation reserve, foreign exchange fluctuation difference, gain on payment of FCCB, and tax on credit or charge in respect of exception. Now all these, majority of the items, this tax I deal separately, but most of these items are actually normal items, they are not exceptional at all. So you cannot, a normal item cannot be shown as exceptional. And merely, I'll tell you one thing, the quantum of the amount is not important. You will have to see all the factors and then determine whether it is exceptional or not. Okay, as regards tax, all tax expenses incurred appearing in the statement should be included under the head tax expense. So it should not be, under. Next. From the following annual report, it has been noted that gratuity liability has been recognized on payment basis. During the year under review, the company has changed its accounting policy from cash basis to accrual basis and has determined the gratuity liability based on actual valuation. However, it was noted that though this policy change was there, the actual provision was not made in the financial statements. So your policy says that there is a change in the method, but your accounts do not show that. That is not good. Whatever is the additional provision, you have to give. Revenue recognition has been stated like this: in respect of construction contract, revenue is recognized on percentage or completion method. Price escalation claims and additional claims, including those under arbitration, are recognized as revenue when they are realized or receipt thereof are mutually settled or reasonably ascertained. Now this is the policy given. Let us see what is the, now what is required. An enterprise should disclose the amount of contract revenue recognized as revenue in the period, the methods used to determine the contract revenue recognized, and also you have to determine the stage of completion of the contract. So all these policies were not mentioned in the financial statement, and therefore there was a non-compliance. In an annual report for construction contract, contract revenue recognized, method used to determine the contract revenue recognized, and the stage of completion of contract in progress was mentioned. However, aggregate amounts of costs incurred and recognized profit, advance received and retention money was disclosed. Now here you have to disclose the gross amount due from customers for contract work. Now that was not done. Merely just, so that is very, very important as per accounting standard 7. This I told you earlier that revenue from sale of tickets is recognized when the tickets have been sold. Advertisement revenue is recognized when advertisements and net realization are confirmed. Now here, the rendering of services are important. Whenever I have rendered the service, the income will be recognized. So now just because I have sold the tickets doesn't mean that my income is recognized. There could be also refunds. So therefore, it is essential that advance booking, there may be a substantial gap between the sale of tickets and that. That will have to ensure that only when the event is done, the income is recognized and not otherwise. Revenue from online educational services is recognized upon receipt of subscription fees. Here also it is on a very, very similar basis that it has to be when the services are given. So in that year, you will have to recognize the revenue, not when the fees are received. So that is also very important. The revenue in the nature of advisory services rendered towards finalization of power purchase, CDM services, etc., when the fees are determined under the terms of respective agreements, and other services on completion of services and bid. But here basically the non-compliance is because when the fees are determined, that is not the time when the accounting should be done. The recognition should be done when the services are actually done. Similarly, billing is not the criteria for recognition of any. So revenue from services should be recognized under proportionate completion method or completed services method. And performance of service should be the criteria for revenue recognition. Dividend is accounted as and when received. Dividend income is considered on receipt basis. Income and expenditure are recognized on accrual basis except dividend on shares which are. Now here, the dividend as per the accounting standard, you have to recognize when your right to receive the dividend has been. So once the AGM takes place of that company of which you are holding the shares and they have passed the dividend at the AGM, then it becomes due to you and you have to recognize as income of that dividend, and not when it is received. Profit on sale of investment is recognized as income in the period in which the investment is sold or disposed of. Now the major flaw here is sale of investment is not a revenue. Your revenue is the profit or loss on sale of investment. So basically the company has considered this as a revenue, which is not a correct. Accounting policy of fixed assets as disclosed in the annual report, underutilized or idle assets are recorded at estimated realizable value, and assets held for disposal are treated at the estimated net realizable value. Now here, the main this is that the running values of idle assets and assets held are written down to their estimated realizable value. Their policy has to be stated that when you are converting, merely doing, just saying that it is being done is not sufficient. But when, because otherwise there could be a manipulation in the account where the book value may be higher or lower and you may try to manipulate the profit or loss. That is the reason why it is essential. The policy has to be mentioned and that has to be complied. Land and building at certain locations were revalued. Gross depreciation for the year includes depreciation on revalued asset charged against revaluation reserve. Now here again, the revaluation, there are certain rules. It's not just that you can do. You have to have the entire class of assets should be revalued. Or if you have selected certain location, the criteria for selection of those certain locations, they have to be stated in the policy. Then only you can. So it was observed that the company has revalued at certain locations, required that either an entire class of assets should be revalued or the basis for selecting certain assets for revaluation should be disclosed. It was noted that the company has not disclosed the basis of selection. Transactions in foreign currencies are recorded at rates prevailing on the dates of transactions. Monetary items denominated in foreign currency are stated at contracted rates as those are covered by forward contracts. Now here, basically they should have done that wherever this forward contract, as on the balance sheet date, you should recognize the closing exchange rate except irrespective of the fact whether risk against such has been hedged or not. So you have to value this as on the date of the financial statement. The company had incurred expenses and earned income in foreign currency. However, in the statement of profit and loss and notes to accounts, there was no disclosure of gain or loss in exchange difference. So you see, there may or may not be, but you have to at least ensure that you have calculated and accordingly disclosed. The gain or loss related to long-term monetary items for financing acquisition of is adjusted to the acquisition cost of such asset and depreciated over their remaining useful life. But here, what is also required to be mentioned is the amount remaining unamortized at the end of the financial year has to be disclosed. So just merely saying that yes, you have adjusted is not sufficient. From the annual reports, it has been said that following grants or subsidies have been received: capital incentive subsidy, central investment subsidy, special capital subsidy, or grant from National Highway Authority. So here, what is the non-compliant? That the accounting policy as adopted by these companies for recognizing the government have not been stated. You have shown the income, but that is not sufficient. Why you are receiving it and when it is recognized as revenue, that has to be stated in the accounting policy. Now, the current investments. The current investments are valued at cost or market value, whichever is lower. Current investments are valued at lower of cost or net realizable value. Current investments, if any, are carried at lower of cost and quoted fair value computed category wise and so on. So these are various disclosures. Now what are the non-compliance? What is the requirement I have given as per accounting standard 13, and the non-disclosure is, non-compliance is the market value does not always reflect its fair value until and unless there is active market for such investment. In the absence of some information, adopting such policy is considered to be not in line with the requirement of law. So if there is no listed security, it may be difficult to determine the fair value. Investments are classified as long-term and current on the basis of the decision taken by the board of directors at the time of taking investments. Now, this cannot be by the board of it will depend on the period of investment and the purpose of investment. That is very, very important. So, current as is based on decision date. However, the policy for determination has not been disclosed. In the annual report of some companies, accounting policies on investments have been disclosed as follows. Investments are treated at cost. Investments are carried at lower of cost or market value, and provisions made to recognize any decrease in the cash value as applicable. Unquoted investments are accounted at cost. Now these are the requirements, and I'll go to the. So it was viewed here that valuing investments without considering the purpose and or the period for which these are intended to be held is against the requirement of it. So whether it is long term, whether it is current investment, the valuation will have to be determined based on the purpose and the period for which the investments have been held. From the notes to accounts, it has been noted that the gratuity liability funded through an insurance company is disclosed under provision of gratuity under the head provisions and LIC group gratuity account under the head loans and advances. So there are two things happening. One is on the liability side, one is on the. Now here, from the above, it was necessary that both should be adjusted, and only the net figure should have been. That was not done. Borrowing costs include interest amortization of ancillary costs incurred, exchange differences arising from.
Sorry.
Borrowing costs include interest amortization of ancillary costs incurred and exchange differences arising from foreign currency to the extent they are regarded as adjustment to interest costs. Costs in connection with the borrowing of funds to the extent not directly related to the acquisition of quantified are charged to statement of profit and loss. So now here the requirement is like this, that the borrowing costs to the extent not directly related to the acquisition of a qualifying asset, they are to be charged to profit and loss account and expensed out. So you have no option. Only when it is related to a particular acquisition of a particular asset, then you take it over there. A related party disclosure. It is noted that the volume of transaction has been disclosed, but the nature of transaction was not disclosed. So again here, the related party disclosure, as I told you, that any accounting standard, once it becomes applicable, you have to comply with it completely. So if whatever disclosures are required, if the nature of transactions is not given, the amounts are not given, then it is not a complete disclosure, and therefore it needs proper compliance. The related party disclosures as given in the annual report, it has been noted that the transactions with the controlling companies and fellow subsidiaries have been disclosed together in a single column. So that is also not correct. Basically, you have to give the name of the transacting related party, a description of the relationship between the parties, and a description of the nature of transaction. All three have to be disclosed separately. Then only there will be a complete disclosure. Now here I have given just straight, I am not taken because the facts were quite long, so here I will just take what is the non-compliant. Now earning per share was not given, or if it was given, whether it was basic or whether it was diluted, that was not mentioned. Now that is very important, that earning per share, particularly the second one, that even if there is no difference in the basic and diluted EPS, to comply with the requirement of accounting standard 20, the basic as well as diluted EPS should be explicitly disclosed. So not just, okay. Deferred tax asset and, deferred tax liability, on what account it has to be disclosed. Now here on account of depreciation has been mentioned, but on account of others. Now the others have to be defined as to what are the other factors where it is. Now here also, only the figures were given at the end of the year, which is not sufficient. You have to give the reconciliation, the opening balance during the year and here wherever intangible assets are there, the amortization rates and the useful lives used has to be disclosed. So that is very important. It was observed from the accounting policy related to fixed assets that telecom licenses are stated at fair value less accumulated amortization. So after initial recognition, intangible should be carried out at cost less accumulated amortization than any accumulated impairment loss. So fair value doesn't come into play there. You have to take the actual cost. This is the balance sheet, and where there was capital work in progress, where only the figures were given as to what is the capital work. And the basic thing is capital work in progress is just like plant and equipment. So therefore, you have to give the reconciliation between the opening balance and the closing balance, even in respect of capital work in progress. Merely mentioning capital work in progress is not sufficient. It was noted that given accounting policy that the company depreciates property, plant and equipment over their useful lives and in certain cases on straight line basis. However, it was observed that the estimated useful lives or depreciation, the amount of depreciation has not been disclosed. So you have to give both. Here the audit report I have started now, but basically these things are now. Here I'll show you one more thing. What are the non-compliances and straight go to that? Because basically it is the audit report content, basically, not that just Now what are the separate section? Now there is a separate section on going concern has not been given. So regarding going concern, you have to give a separate note, which was not given. Then auditor's responsibility relating to other information was also applicable, but the auditor has not reported any other information. The auditor has not reported as per 143(3)(f), which requires the auditor's comments or observations on financial transactions or matters which have adverse effect on the financial functioning of the company. And lastly, it is noted a description of each key audit matter has not been properly given to address the reason for consideration of this matter to be one of the most important, most significant in the audit, and how the matter was addressed in the audit. And so, merely mentioning key key matters or emphasis of matters is not sufficient. This report was there, audit report was addressed to the resolution professional because the company was under liquidation. But the auditor can never address it to resolution professional. He has to address it to the shareholders, to the members of the company. So that was a non-compliance. Now this is very interesting. It's really a typographical error, possibly because of cut and paste technology, but an abstract of auditor's report of XYZ Limited reads as under. Report on internal financial controls over financial reporting under clause 1 of subsection 3 of section 143 of the Companies Act 2013. We have audited the internal financial controls over financial reporting of ABC. Actually, they are doing the audit of XYZ and they have mentioned ABC because of this cut and paste. Now here also it's a non-compliance. So now don't go on that you will get out by saying it is a typographical error. The moment you sign, I will tell you one more thing also, that many a times, the balance sheet totals don't tally or whatever. Now it is no longer a typographical error, or you will have to ensure once you sign that both the totals are tallied and properly tallied.
So copy paste
That
error.
is very. Sorry.
So copy paste error.
Many a times Excel में वो क्या होता है that formula gets changed or whatever, but we don't bother. We say, the formula is there, it will take care. But we don't know, we don't check it. That is what is. Okay. Now, we have audited the accompanying financial statements of ABC Corp, which comprise balance sheet, statement of profit and loss account, including other comprehensive income, and summary of significant. Now here the problem is that financial statements, the definition is given under the Companies Act. So you have to include all the documents which are stated there. Here they have mentioned only balance sheet, profit and loss account, and significant accounting policy and other. Cash flow statement has not been. Or changes in equity has not been. Everything has to be. Okay. In our opinion, and to the best of our information, and according to the explanation given to us, and subject to note given above, the INS financial statements give the information required, and it gives a true and fair view. Now, actually, the auditor has given clean report, but he has used the word subject to, which is not correct. Because the moment he uses subject to, then there is a modification of report or the qualification. So that has to be ensured that it is done. Emphasis of matter. We draw attention, whatever. Now here actually the emphasis of matter has been now replaced with a separate paragraph titled material uncertainty related to going concern. So that has to be given, not emphasis of matter. To ensure that you give the correct. You will have to refer the accounting standards, auditing standards relating to report giving also. It's not just accounting standards. Because the auditing standards are also very, very important. Okay. Next one is impacting on going concern status and companies. There has been no significant or material orders passed by any regulators or courts and companies' operations in future. In preparing financial and management has made an assessment of company's ability to continue as a going concern. Financial statements are prepared on a going concern basis. The management is aware in making its statement of material uncertainty related to events or conditions that may cast significant doubt upon the company's ability to continue as a going concern. Now when the management itself is saying that there are certain material uncertainties, the auditor should at least identify them, and he should mention it in his report also. So that is why director's report, everything is important when you are finalizing your audit report. It's not just that many a times what happens, you give your audit report and you feel the director's report and nothing is our concern. That should not happen. The draft audit director's report also should be considered. Yeah. Now here the key audit matter was given. Key audit matters are those matters that in our professional judgment were of most significance in our audit. Of the stand alone, these matters were addressed in the context of our audit of the stand alone in AS financial statement as a whole, and informing our opinion thereon, and we do not provide a separate opinion on these matters. We have determined the matters described below to be key audit matters to be communicated in our report. Now what has happened is that there was some information required to be given by the management to the, but before that matter information was given to the auditor gave his report. Now which is not correct. In fact, in his audit report he should have mentioned that he has not received that information. So basically that is the so the auditor has not given the reference to the relevant note to accounts and reporting on the key audit matter in his audit report. So that was also not there. Information, the company's board of directors is responsible for other information. The other information comprises including the annual report but does not include standalone financial statement and our auditor's report thereof. This is what India's I'll just go to that. I don't remember now. So I'll just go straight away. The auditor has expressed an opinion on the information other than the standalone financial as on May 15, despite the same, was not available to it. In fact, I told you the earlier that some information was due that was not received, but the auditor issued the audit report, which is not correct. Yes. There is a material difference between principal amount of indebtedness disclosed. Now see, MGT 9, form number MGT 9, part 5, it gives you the principal amount of indebtedness. And your balance sheet also will give you certain, both should match. If it doesn't match, then there is a problem. So you will have to ensure that all these things are checked up before you issue the report. Now here, this is another very interesting. It has said management responsibility for the financial statement. Now the non-compliance is, the correct heading is responsibilities of management and those charged with governance for the standalone financial statement. So if you have not given the correct title, that also would amount. This I remember, once I had done audit of one government company, and that time 2013, I think the new act had just come in. And in that audit, the title of the profit and loss account, I said profit and loss account for the year ended. Believe me, CAG came out with a, that you have not given a proper title. It should be now statement of profit and loss. Now this is something, so all these government regulators and all that, what point they will take out, we don't know. We have to be careful. Okay. Now here I think what has happened is that he has, some foreign branches are involved, but the auditor has not clearly stated that he has not audited some of the branches. And how he has considered the thing in his report, that has not been stated, and therefore that is a non-compliance. Okay. The company has disclosed the impact of pending litigation on its financial position, and there has been no delay in transferring amounts required to be transferred to the Investor Education and Protection Fund. Now, this is also very interesting non-compliance, which you must. Now, what is the thing? Upon it was observed that the financial statement that the company had not provided any details relating to pending. That is my point. See the other one. The Investor Protection Fund, there was no requirement of the company to transfer. But the auditor gave that there has been no delay. Now that is a non-compliance, whereby the auditor should have reported that there were no amounts which were required to be transferred. He cannot say that there was no delay. The wrong information has been given by the. Okay. These are another important this which you should remember. The date of signing the audit report, many times we don't write the date. The date should always be either same as that on which the directors have signed, or it should be after that. But you cannot sign it before. Because unless the auditee himself accepts the statement, you cannot give your opinion on that statement. So that is the logic behind this. Many times firm registration number is not given, or membership number is not given. So you ensure that these are given. Very, very important regarding the balance conveyed received from parties covered under the trade payables, trade receivables, long term and short term. Now none of the major parties have confirmed their balances, and hence differences, if any, could not be identified. Now he has given the facts. But basically, whether it is having any impact on the true and fair view, whether the confirmation he is doubting something, has he complied with any other audit procedure, that nothing has been stated that he has done that, and that is why whatever statement auditor has made, it is question mark. Related party disclosure, the auditor has merely many a times has identified the company and relied upon by the auditors. Now this is one statement that you can never make, either in the financial statement or in your own thing, because once you rely on the management, then you are not audited, you are just accepting. So which is not correct. Now I have taken cargo also one or two items. So where the borrowers have been regular in payment of and repayment of principals and interest. Now according to the information given to us, again that is the question mark. It's not according to the information. And remember, in Companies Act, if you see 2013, the audit report, it says that the information sought and received. So you have to seek information. Merely because the company has not given, it will not absolve you. So therefore, it is very important that you seek the information. The company is regular in depositing with appropriate authorities and distribute statutory views, including provident fund, employee state insurance, income tax, etc. Now it was noted from the financial evidence that the company has neither paid any employee benefits nor made any contribution to provident fund or ESI. Still he has put the words that this means this copy paste. You have just taken the standard and you have put it over, which is not acceptable. Yeah. It was noted from the note on contingent liability that the company has disclosed claims against the company with respect to income tax and sales tax matter. However, it was observed that has not given any reference to it. Cargo report will give the. It was noted that it was reported that the company did not raise any money by way of term loans during the year. However, cash flow statement and note on non-current borrowing that the company has obtained additional long-term borrowing. Financial statements say something else. Sorry. Okay. Again, here the words used were that the fraud. So no fraud by the company or on the company by its officers or has been noticed or reported during the course of our audit. That is not the requirement. The requirement is during the financial year. So that is the basic non-compliance here. Now I am taking some few items which of the Companies Act. Schedule 2 to the Companies Act introduced concept of useful life of asset instead of using specific depreciation rates as provided in Schedule 14 to the Companies Act. Therefore, the view is that Schedule 2 to the Companies Act provides only straight line method of depreciation, which is not depreciation. So you can use any method of depreciation. However, it only says that the useful life and the how much you have to write up over a period of time, the cost, that has to be taken into consideration. Depreciation of those assets whose actual cost does not exceed ₹5,000 has been provided at the rate of 100% in accordance with Schedule 2. Now that is also not permitted because now as per the new Act, there is no such provision. However, if suppose the life of the asset of the particular asset is less than 1 year, you write off within 1 year, that is okay. But 95% only has to be that good. Investments were classified into current and non-current, whereas Accounting Standard 13 requires to classify investments as current and long-term. So now here you will have to have, and accounting standards will have a precedence over the act. There you will have to show the investments as current and long term. That is what is very important. At times, companies have classified deferred tax asset or liability as current and non-current tax. Now there cannot be current category. Deferred tax or asset has always to be non-current. There was some amount unpaid towards shares subscribed by the subscribers of MOA. The company gave descriptive note for the same without any treatment in financial statements. Now here again, the treatment in the accounts was wrong. Unpaid amount should be shown as, should be considered as subscribed and paid up, and you should show as amount receivable under asset side. The company was having some investments in LLPs. The company disclosed the same under the heading investments in partnership firm, which is not permitted. So you will have to do it under other investments. LLP is not classified under partnership firm. That's very important. The company was engaged in manufacture of cars and had made sale of scrap which was generated during the manufacturing process. The company disclosed the sale of scrap as other non-operating income, which is not correct because the scrap was out of the main business. The company has incurred CSR expenditure, and they had shown as other expenses. So that is also not permitted. CSR expenditure has to be shown as CSR expenditure. That is very important. So with this I have completed the examples. Now I will go through the key takeaways. Compliance is fundamental. And it is accurate financial reporting is not optional, so it is mandatory. It builds stakeholder trust. Transparent report enhances the credibility of with the investors, regulators, etc. Avoids regulatory and legal penalties. It drives informed decision making, because if the data is correct, then your decision also will be to that extent correct. Enforces governance and accountability by the management. Chartered accountants generally play a crucial role because they ought to ensure accuracy, completeness and consistent of disclosures. Legal framework is robust and mandatory. Real world cases reinforce the risk. Fraud cases demonstrate how lack of compliance can lead to massive consequences. Non-compliance is equal to operational and financial risk, and compliance safeguards the profession and the economy. My only conclusion here would be that gone are the days when we can oblige our clients. I don't think. If you go on a